Hi, Elliot Gu here. I'm co-founder and chief strategist for Energy and Income Advisor. Before I get started, I have to warn you that I'm pretty fired up, actually downright angry, about some of the misinformation I've been reading in the mainstream financial media over the past few months. I'm furious because one of the often repeated investing myths, actually it's just a downright lie, is threatening what many of my readers tell me is their biggest investing goal: generating real income, yields, and dividends from their portfolios. When you find out how this lie got started, you'll really be steaming. That's okay, I'll be revealing the truth in just a moment. However, if you don't like controversy, you might want to just click away right now. Let me ask you this. Are you worried about your income stocks, that's dividend-paying stocks, in a rising interest rate environment? Keep watching this presentation through to the end, and I'll show you one of the most powerful income investing tips I've ever used. A key characteristic I look for that could help you generate yields of 6%, 8%, or even 10% and higher from your investments in master limited partnerships and other high yield groups just over the next 12 months alone. Even if the Fed keeps hiking rates, and even if the yield on the 10-year US Treasury bond shoots to 3% or higher by the end of this year. Curious? I'm sure. However, it will all make perfect sense to you in just a few minutes. Here's the myth. Income stocks and MLPs perform poorly in a rising interest rate environment. That's absolute bull. As I'll explain in just a moment, some income stocks have actually handily outperformed the broader market when interest rates are on the rise. The secret is to look for stocks that fit certain income patterns that I'll tell you more about in just a few moments. And this point is absolutely crucial. Buying income stocks in rising rate environments calls for different techniques than when rates are low and or falling. In just a moment, I'm going to give you all the details you need about the most important characteristic to look for. However, if you continue to believe that you must sell your energy stocks because the Fed is hiking rates or bond yields are on the rise, you're going to miss out on some of the best income and capital gains opportunities I've seen in the past decade. That's not what I desire for you. Listen, I prepared a short presentation I plan to send out only to subscribers to our flagship Energy and Income Advisor service. This presentation proves with cold, hard facts that income stocks can perform very, very well when the Fed hikes rates, if you know what types of income stocks to buy. I've decided that this presentation is too important to just hide behind a paywall, so I'm releasing this video today as part of this free presentation. I urge you to challenge every single one of my facts, and you'll find that I'm right about each allegation I make. This presentation could save you from some devastating mistakes over the next 12 months and set you up for some life-changing income and profit opportunities. I've got to warn you, this video is raw, unscripted, and only lightly edited. However, I just couldn't delay giving you this crucial information any longer, not to clean up the audio or make a few charts look prettier. I guarantee I won't waste your time. Watch my short video presentation through to the end and decide for yourself if I'm for real or just full of hot air. Hello, my name is Elliot Gu and I'm editor of Energy and Income Advisor. And today I want to talk about one of the biggest and most expensive investing myths out there. And that's the idea that when interest rates are rising, when yields on government bonds are rising, you want to sell all dividend or distribution paying stocks. You want to sell all stocks with a yield. And if you're like most people out there, you've probably heard this 1,000 times over the last year or so. As many of you know, the Federal Reserve raised interest rates for the first time in nearly a decade back at the end of 2015, and they did it again at the end of last year, at the end of 2016. And you often read, well, when the Fed starts raising rates, you want to sell all dividend stocks, all income stocks, and buy more growth stocks. And this is actually totally a myth. And today I want to tell you exactly why that's the case, exactly how this myth got started, why it's a myth, and show you one key characteristic you can look for, that we look for, in income-paying stocks and actually make them outperform the broader market in a rising interest rate environment, in a rising rate environment. So income investors, don't despair. This common refrain you've probably heard on financial television, in various financial publications, other newsletters, is totally wrong. You can actually make plenty of money in a rising rate environment. In fact, it can be really good for income investors if you follow some pretty simple rules, which I'm going to explain today. Here's how this myth got started. The idea is that when interest rates are going up, it does tend to be bad news for most bonds. Now, I'm going to oversimplify terribly today in this part of the presentation, just to illustrate a point. But when interest rates are rising, it does tend to be bad news for bonds. Not all bonds, but in general, it's bad news for bonds. And the idea goes something like this. If interest rates go up, the price of a bond goes down. And here's why. Let's say that you own a $1,000 corporate bond, a bond issued by a corporation that pays that sold for $1,000 for one bond. That bond pays $50 a year, every year for 10 years, and then pays you back your $1,000 principal at maturity. The current yield on that bond would be 5%, right? Because you're getting $50 a year in interest payments and coupon payments, and that is 50 divided by 1,000 is 5%. So the current yield on that bond that I just described, and this is just a hypothetical example of a bond, is 5%. But let's assume that you bought this bond, and then about a year later, prevailing interest rates rose to 7% for bonds of similar maturity, which now this would be a 9-year bond, right? Because you owned it for about a year, issued by similar companies with similar credit quality. So companies in the same, let's say in the same industry group or the same sector, similar credit ratings from Standard & Poor's or Moody's. Those bonds now, 1 year after you bought this bond, are yielding about 7%, $70 per year for a $1,000 bond. So obviously, no one is going to go out and buy that $50 a year bond when they can get a similar bond issued by a similar company, or maybe even the same company, that pays $70 a year. They're not going to do it. They're not going to buy that bond that yields 5% when they can get a bond with similar risk profile that yields 7%. It just doesn't make sense. Now, there's no way, because it's a fixed income investment, that coupon payment is fixed for the life of the bond. There's no way for that yield, for that 5% coupon payment to go to 7%. It's always going to pay $50 a year. It's not going to pay $70 a year. What can change, though, is the price of the bond, right? So no one's willing to pay you $1,000 for a bond paying $50 a year. But they might pay you $700 for a bond paying $50 a year, because $50 is about 7.1% of $700. So you can see right there, when prevailing interest rates rise, in general, the price of bonds is going to drop. In this example, by $300 or 30% of that $1,000. The price of the bond is going to drop so that that same fixed coupon payment of $50 a year is worth 7%, a little over 7%, which is what the prevailing interest rate is at the time in this example. So that's a very simple example. There are all kinds of other factors that go into it, the maturity on the bond, what the credit quality of the issuer is, but just in basic, when interest rates are going up, the price of bonds is going down. So a lot of people say, well, if interest rates are going up, then income stocks should also go down as well, right? Because if, say, the yield on a US government bond is 1%, and then a year later it's 3%, then it makes those government bonds, for example, more attractive because they're offering a higher yield. And therefore, if you have a dividend-paying stock that's paying, say, 5%, it makes that a little bit less attractive because obviously the dividends for most stocks are much riskier than the government, the US government, paying the interest on the bonds that it issues. So it might make that bond more attractive relative to that dividend-paying stock. So the basic theory is that when interest rates go up, it makes dividend-paying stocks look less attractive. Okay, here's why that's wrong. Dividend-paying stocks are not fixed income investments. They're not bonds. The dividends are typically set by the management team and the company's board that votes on whether to pay a dividend or not, and how much, and whether they accept management's dividend proposals. So dividends can go up or down. Dividends can go down if a company doesn't have enough cash to cover its payout, wants to conserve cash. they might cut their dividend, which tends to be disastrous for the stock. Other companies boost their dividends over time because their profits are going up, they have more cash available for distribution, and they want to pay a higher dividend. Now, think about it. If the dividend is rising, the faster the dividend is rising, the less like a fixed income investment that company is. If a company has a flat dividend, let's say it's paying a 3% yield, and that 3% yield may be very attractive if the prevailing interest rate, if say a 10-year US government bond yields 1%, right? So if the 10-year US government bond yields 1%, that 3% dividend yield might be very attractive. But if the 10-year US government bond yields 3%, then that 3% dividend yield is much, much less attractive, right? So if that is a flat dividend, it's almost like a fixed income, it's more like a fixed income investment. Or if that dividend is vulnerable to a cut. In other words, if you think that maybe because interest rates are rising, the company's more likely to cut its dividends, maybe it's in some sort of in industry related to housing that's vulnerable to interest rate hikes. So if that dividend is vulnerable to a cut or it's flat, then it's going to be more sensitive to interest rates, kind of on the left-hand side of this diagram on your screen. If, however, there's visible dividend growth over time, or visible distribution growth over time, and a commitment by the management and the company to grow dividends, or at least pay out some portion, some fixed portion of their profits as dividends or distributions, then that growing dividend over time means that that company is not a fixed income investment. Because you're not going to just get $50 a year every year for 10 years. You might get 50 this year on a $1,000 investment, 5% yield. You might get 60 next year. You might get 70 the year after that if it's boosting its dividends at, say, a pace of $1 per year or $10 per year total for that $1,000 investment. So the faster the dividends are growing, the less like a fixed income investment that company or master limited partnership is. And master limited partnerships in the energy sector, which is the sector I cover, we cover most closely in Energy and Income Advisor, that's the group we're often asked about. I get this question, it must be one of the most common questions I get. I must get this question a couple dozen times a month. Should I sell my master limited partnerships, which tend to be high yield investments, because interest rates are rising? And the answer to that question is no, you shouldn't, but you should focus on master limited partnerships with a visible growth in their distributions, so that are able to grow their distributions over time. Those stocks, those MLPs are going to be less interest rate sensitive and can actually do very well during rising rate environments. So let me just prove this to you. Let's look at a couple of different periods where rates rose. First off, let's look at the last major Fed rate hike cycle, which was between June 2004 and June 2006. So this is basically a 2-year period. As you can see on this chart on your screen, interest rates rose from about 1% all the way up to 5.25%. So it was a 4.25% boost in interest rates in the upper bound of the Fed funds rate, which is the interest rate that U.S. Federal Reserve controls, over roughly a 2-year period. Let's look at the performance of various indices over this time period. Over that 2-year period, the S&P 500 was up a total of about 15.4%, as you can see from this chart. So the S&P 500 was up 15.4%. Now, again, if you follow that old adage, which I'm telling you is a myth, to sell dividend-paying stocks when the Fed is hiking interest rates, then the first 2 sectors you probably look at are the utilities, which tend to yield above higher than average yields, tend to offer higher than average yields. I'm talking about companies like electric utilities, like Dominion or Exelon or Next Era Energy, which is the parent of Florida Power and Light. Whatever you want to look at, those utilities tend to offer above average yield. So if you want to sell, if you think that you should sell high yield stocks when interest rates are rising, when the Fed is boosting interest rates, then you would probably, and you often hear directly, sell the utilities because the Fed is raising rates. How many times have you heard that over the last year or so since the Fed started hiking rates? Well, that didn't work at all back in 2004 to 2006. If you bought the Dow Jones Utility Average Index at the end of June 2004 and sold it at the end of June 2006, you would have earned almost a 60% return, a 59.4% return, which is almost 4 times what the S&P 500 returned over the same time period. So in this case, you wanted to buy this high yield group when interest rates were rising, not sell it, because it outperformed the S&P 500, and not by a little bit, by 4 to 1. The Alerian MLP index, which is an index of a lot of these 50 of the larger master limited partnerships in the United States. And as I explained, these are this is a high yield group. Currently, this group yields an average of about 7%. So it's a high yield group. Mainly, these companies own assets like pipelines to carry oil and natural gas and gasoline and diesel fuel, as well as storage terminals for energy-related products. They're mainly in what we call the midstream energy business. Again, another high yield group that was up 38.7% over that same 2-year period, outperforming the S&P 500 by almost 3 to 1 over that same time period. The only thing which the S&P 500 beat on this chart is an investment in the iShares 20-plus year exchange traded fund. This is an exchange traded fund, or ETF, that tracks the performance of long maturity U.S. government bonds, in this case 20-plus year maturity U.S. government bonds. So even though the Fed was raising interest rates, bond yields didn't rise much, and therefore you got a 10.4% return on government bonds over that 2-year period. Most of that was actually just the interest paid on those bonds. The actual price of the bonds was down slightly, but you got the interest payments on the bonds over that 2-year period actually generated you a small positive return. But look at this. Even though bonds underperformed, and investment in government bonds underperformed the S&P 500 in this rising interest rate environment, these high yield stocks, the utilities and the MLPs, massively outperformed the broader market, even though interest rates were rising. So you can see right there, in the last major interest rate hiking cycle, that old adage was definitely a myth. You wanted to own high yield stocks in the rising interest rate environment. But let's dig into that a little bit further. What I did is I took the Alerian MLP index and I looked at it over that same period between 2004 and 2006. So I took all the MLPs in that index and I sorted them by distribution growth. So not their total yield, right? But how much did they grow their distributions over that 2-year period? Did they say grow their distributions from a quarterly rate of 50 cents a quarter up to 60 cents, right? Over that 2-year period? What was their total growth rate in distributions per unit, per share, or dividends per share equivalent over that 2-year period? And so I ranked all of the MLPs in the Alerian index by that metric. I looked at the 10 MLPs out of all the MLPs in that Alerian index, and that offered the highest distribution growth over that 2004 to 2006 period. And those 10 MLPs generated a 56.5% return over that same 2-year period, which outperformed rather handily by almost 20 percentage points that 38.7% return on the Alerian MLP index. So again, because those MLPs offering faster distribution growth are less like fixed income investments, they tend to perform better in rising interest rate environments. In contrast, I also looked at the 10 MLPs with the slowest distribution growth over that 2-year period. A couple of those names actually cut their distributions during that rising interest rate environment period, and on average, those 10 MLPs showing the slowest distribution growth only returned 5.44% in total over that 2-year period. So they massively underperformed the S&P 500, the Alerian MLP index, the Dow Jones Utilities, and they performed about 50% less, more than 50% less. They offered 50% less of a return over that period from June 2004 to June 2006 than the MLPs showing the fastest distribution growth. So do you see this? You see that the faster MLPs grew their distributions, the better they performed in the rising interest rate environment. That's again because MLPs with flat distributions with just a high yield but no growth are more like fixed income investments, they perform, and which tend to get hit during rising interest rate environments. Those with growth, the potential to grow their income, the income that they offer unit holders or shareholders over time, are less like fixed income investments and therefore are not particularly rate sensitive, do not perform in line with interest rates, inversely to interest rates. Let's look at utilities over the same time period. I looked at the S&P 500 Utility Index, and this is a little different index than I used on the prior chart. I picked it because it actually has more stocks in it. And so this has, I believe, about 35 stocks in it, the S&P 500 Utility Index. And I looked at it over that 2004 to 2006 period. The S&P 500 Utility Index returned about 45.9% over that time period. So it did pretty well compared to the S&P 500, up 15%, outperformed by about 40 percentage points over just 2 years, which is pretty amazing. The Dow Jones Utilities, as I said, performed a little better than the S&P 500 Utility Index. It was up almost 60% over that same time period. But the 10 utility stocks with the fastest dividend growth over that period from 2004 to 2006 outperformed both the S&P 500 Utility Index and the Dow Jones Utilities, returning more than 64% over that 2-year period. Whereas the 10 utilities with the slowest distribution, the slowest dividend growth, or that cut their dividends over that time period, only returned 27.3%. Again, utilities that have growth potential are not like fixed income. Those with no growth potential or at risk of cutting their dividends are far more rate sensitive, and you can see it very, very clearly on this chart. So let's look at another time period, because you might say, well, that period, maybe that was an aberration, right? Let's look at another time period and a slightly different indicator, and that's what we call the taper tantrum. And this was a period from May 2013 up until December of 2013. And the reason it was called a taper tantrum is because back in early May of 2013, the Federal Reserve came out and said that they were going to start to taper the pace of quantitative easing. So what that means is what they were doing under quantitative easing was they were buying government bonds every month. They were buying billions and billions of dollars of government bonds every single month to try to push down rates and push down yields on all sorts of bonds. Not just government bonds, but trying to push down the yield on corporate bonds as well by buying these government and mortgage-backed securities. And what they said in May 2013, it wasn't that they were going to raise interest rates. It wasn't even that they were going to stop quantitative easing. It was that they were going to slow the pace of quantitative easing gradually over time. And this came to be known as tapering quantitative easing. And the market's reaction to this became known as the taper tantrum. And what happened here was that the 10-year U.S. government bond had a yield of about 1.63% on the 2nd of May of 2013. And that jumped all the way up to over 3% by December of 2013. So that was a jump of about 1.4% in government bond yields, almost a doubling of government bond yields over just a fairly short period of time. It was the early May up through December. So let's call it the last 3 quarters of that year. There was a big surge in U.S. government bond yields. So interest rates were rising, though the Fed wasn't raising rates. It was tapering the pace of quantitative easing. So let's look at what happened during the taper tantrum to all these different indices. The iShares 20-plus year Treasury bond ETF, as I said, an ETF that tracks the performance of long-term U.S. government bonds, it got slaughtered during this time period. Over what amounts to a little over a 6-month time period, this ETF was down more than 15%. So for just a little more than 6 months, these bonds, which most people think of as safety-first investments, got killed, down 15.2%. The S&P 500, though, did really well. It was up more than 17%. A lot of that had to do with the fact that the Fed was willing to taper the pace of quantitative easing meant that they felt the economy was getting a little bit better. So that's good for stocks. The S&P 500 actually soared over this time period. Now, dividend-paying groups, the MLPs and the utilities, underperformed the market during the taper tantrum. The Alerian MLP index was up about 5.6%. which is less than a third what the S&P 500 was up. And the Dow Jones Utilities Index was down, the S&P 500 Utilities Index was down 5.5%. So it was down while the market was up 17%. So it wasn't down as much as the bonds were, but it was down quite badly in this period of rising bond yields. But let's look at those same groups that I looked at on the prior slides with reference to 2004 to 2006. The top 1/3 of MLPs ranked by distribution growth during the 3 final quarters of 2013 actually rose almost 11% over that same time period. So not quite as much as the S&P 500, grant you, but a very respectable performance over what amounts to basically a little more than 6-month holding period. These MLPs did very, very well, and they outperformed the overall MLP index by a margin of nearly 2 to 1. In contrast, the bottom 1/3 of MLPs ranked by distribution growth returned less than 6%. So they returned roughly in line with the Alarian index. So again, faster distribution growth, less interest rate sensitive, can do well in a rising interest rate environment, even an extreme spike in yields such as we saw during the taper tantrum. And the same thing worked with utilities. The top 1/3 of utilities ranked by dividend growth were up 9.2%. Again, not as much as the market, but very respectable for a little over a 6-month holding period. Most people would be very happy earning 9% plus over 6 months in any interest rate environment. And the bottom 1/3 of utilities on this basis were also down. So again, faster dividend growth, faster distribution growth meant stronger performance in this rising yield environment, even when that jump in yields, as I showed you on this chart, was very sharp and very fast. A pretty extreme environment. You can still do very, very well with dividend distribution paying stocks if you pick the names that offer the most distribution growth, the most dividend growth, because they're the least like fixed income. And I'm not telling you this is the only factor we look at. It's one of several factors that we look for in income stocks during rising rate environments. It's just, I would say, probably the most important generally. So let's move on and look a little bit more. So the other part, and this is the last illustration I'm going to show you, and that's the S&P 500. And what I did was I took the S&P 500, and I'm looking during the taper tantrum environment of May 2013 through December 2013. And so I looked at the S&P 500, and I eliminated all the S&P 500 companies that don't pay a dividend at all. And then I took the top 50% of dividend-paying S&P 500 companies ranked by yield. So I picked the half of the dividend-paying S&P 500 that had the highest yield. So these are the highest-yielding S&P 500 companies. If you follow that adage I showed you at the beginning, which I'm telling you is a myth, that you should sell high-yield stocks when interest rates are rising, these highest-yielding S&P 500 companies, if that's true, they should underperform the broader market in a period of rising interest rates like during the taper tantrum back in 2013. And you can see, as I said, that the S&P 500 during that time period up over 17%. All of the dividend yielding S&P 500 names, all the S&P 500 companies that offered any kind of a dividend yield at all, returned about 14.2%. So while that is a little bit underperforming the market, it's hard to say that's a huge underperformance over a 6-month period. You still did pretty well owning S&P 500 companies that offered a yield, just not quite as well as buying the S&P. But now let's look at that a little bit more. And I took the 50 S&P 500 companies with the fastest dividend growth in 2013. And those stocks actually performed about in line with the broader market during the taper tantrum. They were up almost 17%, just a slight underperformance there. So again, not a noticeable or particularly significant, certainly not statistically significant, shortfall in performance, even though interest rates were rising. So you didn't have to sell all your dividend-paying stocks during that taper tantrum. The ones that had the fastest distribution growth, that were least rate sensitive, did very well during that environment. The bottom, certainly not a reason for income investors to panic at any rate. The 50 S&P 500 companies with the slowest dividend growth over in 2013 only rose 10.3% over this period. So they still had a positive return, but considerably less than the S&P 500 as a whole. So once again, rising interest rate environment, dividend growth is a great thing to look for in income investments that you own. I did the same thing with the S&P 500, and I looked at it in that 2004 to 2006 time period. And again, the S&P 500 was up in that 2-year period a little over 15%. The S&P 500 companies that paid dividends were up 21% over that time period, so they actually outperformed the S&P 500 as a whole. The 50 S&P 500 companies with the fastest dividend growth generated a 26.5% return, so they were up 11% more than the S&P 500 over that time period. And those with the slowest dividend growth actually performed better than the S&P 500 as well, up 17.6%, but about 10% less than those fast dividend growing S&P 500 companies. So the point of all this is that the idea that you should sell all income stocks when the Fed's raising rates or when yields are rising is complete bunk. It's a complete lie, and the empirical evidence shows us that that's the case. It shows us that in many cases, such as 2004 to 2006, income stocks perform even better than the broader market in a rising interest rate environment. And in all periods, it's very important to look at whether an income stock is more like a bond, in other words, it doesn't have any growth potential for its dividends or distributions, or it does have growth potential for dividends and distributions, in which case that makes it less rate sensitive. So the bottom line is, when interest rates are rising, you can still buy dividend stocks. You can still earn income. You don't need to panic. You don't need to invest in some shaky growth company because you think you're going to underperform. You can still buy MLPs. You can still buy utilities, but you need to be careful. You need to focus on MLPs. You need to focus on utilities with the potential to grow their payouts over time. Look, I know many of my peers are advising investors to sell all income stocks right away and focus on growth stocks or settle for meager sub 2% yields available on less interest rate sensitive short-term bonds. However, I'm finding a ton of strong buy candidates in income-oriented groups like the Master Limited Partnerships. MLPs that are on track to steadily boost their distributions to investors over the next 2 to 3 years. These stocks offer yields of 5%, 8%, even 10% and higher, plus growing income streams. One MLP we recommend with a yield of 8.5% owns crucial pipeline and gas processing infrastructure right in the heart of 2 of America's fastest growing shale fields. Simply put, some wells drilled in the Stack Field of Oklahoma and the Delaware Basin of Texas and New Mexico are profitable even with oil around $30 to $35 a barrel. Production from both fields is soaring, and this high-yield MLP is partnered with one of the largest and best-positioned producers in both regions. And this MLP fits one of the most profitable income investment angles we've ever uncovered. You see, since August 2015, this MLP has not increased its quarterly distribution. However, we're looking for it to bump up its payout by the end of this year. Historically, an MLP's first distribution hike after a long period of paying out flat quarterly dividends is a strong upside catalyst for the stock. We see 30% or more in upside for the stock, and that's on top of its rock-solid 8.5% yield. And we've also identified an MLP with a 5.5% yield that's likely to boost its payout at a 12% to 15% annualized pace over the next few years. This MLP owns irreplaceable assets in the heart of the largest and cheapest to produce natural gas field in the U.S. Management is also considering a deal that would dramatically increase the income growth potential for this MLP over the next few years. Other MLPs have done similar deals over the past 5 years, and our research work suggests it could generate a quick 20 to 30% pop in the partnership this year. Look, I don't have time to tell you all you need to know about these 2 high-yield MLPs in this short presentation. However, I've assembled all the details of these 2 MLPs and 3 more of our top income recommendations for 2017 in a special report entitled simply Top Energy Stocks for 2017. And in just a few moments, I'm going to show you how you can gain access to this exclusive premium research report with absolutely no risk or obligation, only through this website today. However, before I get into all that, I want to tell you about a second profit step we're recommending. Look, I never thought I'd say this, not in my wildest dreams. However, I've got to say, thank you, OPEC. Listen, the Organization of Petroleum Exporting Countries, or OPEC, has no interest in helping the United States or America's key allies like the United Kingdom. And frankly, I'm shocked they walked into this particular trap. I believe this never would have happened if Ali Al-Naimi, Saudi Arabia's oil minister for 20 years, were still in a leadership role at OPEC's most powerful producer. Look, OPEC's recent deal to trim its production by 1.2 million barrels a day might seem like a no-brainer for the cartel. However, it's actually costing OPEC members billions and billions of dollars this year. You see, due to lower oil production volumes, the International Monetary Fund recently cut Saudi Arabia's economic growth forecast for this year from 2% to just 0.4%. And consensus forecasts for growth across the Middle East and North Africa have fallen sharply since OPEC announced its production deal on November 30th, as lower output offsets the gains in oil prices that we've seen. OPEC might be willing to accept slower growth in the short run if it meant higher prices longer term. However, the cartel did not expect this. Since the middle of 2016 alone, U.S. oil production is already up by 533,000 barrels a day. In February, we're looking for U.S. oil production to top 9 million barrels per day. And by the end of this year, U.S. oil output should easily exceed its 2015 peak of 9.61 million barrels a day. U.S. oil production is rising because U.S. shale producers have been hard at work during the long two-year oil bear market, adopting new technologies and new drilling practices that have dramatically lowered the cost of oil production in some of America's largest shale fields. Simply put, OPEC's production deal is lining the pockets of several well-positioned American shale producers. Meanwhile, the energy-friendly Trump administration is paving the way for strong growth in output, a lighter tax burden, and strong free cash flow growth for the group. I've assembled a list of 4 shale producers with acreage in the most economic shale fields in the U.S. and the most upside potential this year. All the details of these stocks and the exact prices where we recommend purchasing these names are included in our premium report, Top Energy Stocks for 2017, available risk-free through this website, but only for a limited time. I'll tell you how to reserve your copy of this premium 24-page report, available in convenient PDF format, in just a moment. First, I want to tell you about this. Just for watching this presentation today, I want to issue you a very special, risk-free invitation that's open to just a handful of our current subscriber base. That's less than 1% of our database. My colleague Roger Conrad and I want to give you our quick start guide to the key profit steps you must take to profit from OPEC's recent production deal, the policies of President Donald Trump, and the generational changes underway in global energy markets. Simply put, I want to send you a recording of a special, roughly 2-hour-long investing strategy session my colleague Roger Conrad and I recently recorded. Listen to this exclusive strategy session and we'll uncover the U.S. shale field that's been a hot topic at just about every energy industry event, conference, and cocktail party Roger and I have attended over the past 12 months. While this field has the energy industry buzzing, it's still largely a secret to most individual investors. We'll cover the 2 best positioned producers in this under-the-radar shale field, including our exact recommendations for when and at what price to buy the stocks. Plus, we'll tell you the names of 2 master limited partnerships with yields of 7.9% and 8.4% that own crucial infrastructure right in the heart of this field. And don't forget, it's just as important to know which wealth-sapping stocks to avoid as it is to understand the best names to buy right now. We'll also cover a large oil producer. This one has a $15 billion market cap with acreage in this secret shale field that's widely recommended to investors. Yet this popular stock's acreage is not in the most profitable core of the field, and its exposure in other regions has us very, very worried. Trust me, you'll want to sell this widely held name right away, as we believe it could collapse as much as 40% to 60% this year. And we'll also cover the 3 absolutely crucial energy infrastructure projects we're monitoring that are now on the fast track for completion thanks to the incoming Trump administration. These projects are reopening what some believe to be the largest single source of oil in the entire world. Our top pick is a high-yield name we've been covering since 2005. Since then, the stock has consistently raised its dividend, even through some of the most extreme bull and bear market environments in stocks and oil in history. However, what makes this company so attractive is that it has the pole position in a critical resource that's going to be in very high demand as the 3 projects we're tracking are completed. Plus, over the past 3 years, U.S. natural gas exports to Mexico have jumped an incredible 194.07%. And demand is only going to grow as Mexican gas production just can't keep pace with demand. You may have never heard of our top recommendation on this booming growth market, as this company is not a household name. However, our under-the-radar recommendation has a 3.9% yield and the potential to triple in size over the next 3 years. And we also want to tell you exactly what the smart money is doing in energy markets. I'm talking about the private equity firms that are quietly buying up North American energy assets right now on the cheap. Our research confirms that one small firm in the U.S. with an 8.4% yield, that's growing its payout at 10% per year, is an extremely likely takeover target for these smart money investors this year. Trust me, you'll want to buy this stock, currently trading at around $20 a share right away, as we believe a takeover offer at a fat premium could be imminent. Look, I don't have time in this short presentation to tell you all about all the trends, recommendations, and warnings we've covered in our Energy Outlook strategy session this month. And quite frankly, this recording would normally be open only to long-term, paid in full VIP members to our service. Yet, as I said earlier in this presentation, I believe the information we're covering is so crucial to your wealth and investing success this year. I've decided to offer a recording of this VIP event today through this website with no risk or obligation. Here's how it works. Simply click the button labeled Start Your Risk-Free Trial, located below this presentation, and take a trial subscription to Energy and Income Advisor. Read 2 detailed monthly issues of Energy and Income Advisor. We'll also tell you exactly how to log on to our exclusive members-only website and access our model portfolios, offering allocations for growth, income, aggressive, and conservative investors. And I want to make sure you're on the right track with your energy investments starting immediately, even before you've had time to review our 2-hour energy investment strategy session and read our detailed top energy stocks for 2017 premium research report. The first step is to sell the most dangerous energy stocks in your portfolio right away before the next wave of the energy cycle unfolds. Once you've logged on to our website, I want you to read our latest hot-off-the-press research report titled Risk Avoidance. In this report, we've identified 8 widely held energy stocks and MLPs that we consider particularly dangerous investments this year. The list includes income stocks we believe could have to dramatically reduce their dividends this year with devastating consequences, as well as some growth names that are set to disappoint investors, even if oil prices hover in the $50 to $60 a barrel range this year. Now let me ask you a simple question. Wouldn't it be great to be able to pose any question you like about the stock market, economy, or individual stocks and bonds and have those questions answered? Let me tell you about our monthly web chats, a feature of our service Roger and I pioneered a decade ago. It is still the most popular feature of the Energy and Income Advisor service. These chats are an opportunity for you to ask us any question you wish about stocks, our recommendations, the economy, or the broader market. Ask any question you like, and we'll answer every question we're asked on the chat. Our next scheduled online chat is coming up at the end of this month. Just enough time for you to read our research, listen to our energy investing strategy session, and prepare any questions you have. Click the button below this video. Sign up for a risk-free trial subscription to Energy and Income Advisor today, and we'll rush you the details of how to log on to our exclusive, subscriber-only online chat. We believe there's no better service on the market today, and all we're asking is that you give us a fair try and see for yourself. If you don't believe it's worth every dime of the subscription price, cancel in the first 30 days to receive a full refund, no questions asked. We guarantee it. And for viewers today, we're offering Energy and Income Advisor at our special introductory price. Test our service for 30 days, read our research, and join our monthly web chat. Then decide. If Energy and Income Advisor isn't for you, cancel in the first month. Keep your reports and your recording of the VIP Energy Strategy session, and I'll refund your full subscription price, no questions asked. Here's to your wealth. To start your risk-free trial, please click the Start Your Risk-Free Trial button below this presentation and join us today.